On a strip of sandy soil lies a county called Norfolk. It's Ontario, south coast, you know, and it's surely not remote. If you pass through or spend a day or decide to call it home, you'll see why we love it here and are proud to call it our own. Norfolk, Norfolk, a southern county home. Norfolk, Norfolk, we know you can't go wrong with the friendly folk of Norfolk. You won't be a stranger long. Take in the small town atmosphere, be amazed at all that we grow. Like our kids that go and see the world and can't wait to return home. Drop a line in a placid lake or stroll along the shore. Take a tour on a peaceful country road and bound to be back for more. Of Norfolk, Norfolk, my southern county home. Norfolk, Norfolk, we know you can't go wrong with the friendly folk of Norfolk. You won't be a stranger long. With hard work we built a dream that only willing hands could do. It's on display at our fall fairs and at all the festivals too. Erie beaches, Carolinian forests, where the flower and dogwoods bloom. Patchwork fields and rolling hills, it's just the place for you. Norfolk, Norfolk, a southern county home. Norfolk, Norfolk, we know you can't go wrong with the friendly folk of Norfolk. You won't be a stranger long. Norfolk, 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 you won't be a stranger long. On a strip of sandy soil lies a county called Norfolk. It's Ontario, south coast, you know, and it's surely not remote. If you pass through or spend a day or decide to call it home, you'll see why we love it here and are proud to call it our own. Norfolk, Norfolk, a southern county home. Norfolk, Norfolk, we know you can't go wrong with the friendly folk of Norfolk. You won't be a stranger long. Take in the small town atmosphere, be amazed at all that we grow. Like our kids that go and see the world and can't wait to return home. Drop a line in a placid lake or stroll along the shore. Take a tour on a peaceful country road and bound to be back for more. Of Norfolk, Norfolk, my southern county home. Norfolk, Norfolk, we know you can't go wrong with the friendly folk of Norfolk. You won't be a stranger long. With hard work, we built a dream that only willing hands could do. It's on display at our fall fairs and at all the festivals too. Erie beaches, Carolinian forests, where the flower and dogwoods bloom. Patchwork fields and rolling hills, it's just the place for you. Norfolk, Norfolk, a southern county home. Norfolk, Norfolk, we know you can't go wrong with the friendly folk of Norfolk. You won't be a stranger along. Norfolk, 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 you won't be a stranger along.
Good afternoon, everyone. I make the time 3 o'clock p.m. It is March 27th. And this is our council meeting to round out the month of March. Again, you're tired of me saying this, but I will remind you that our meetings are televised. They're web streamed. If you have some little electronic device that makes a racket, you want to just check and make sure it's silenced. Mine is. We'll be in better shape. Guess what? Our volunteer camera person is Bill Jackson again. So again, Mr. Jackson, we say thank you for assisting with our broadcast. If you want to have a look at your agenda, councilors, there are no changes to the agenda this evening. That's the first in a while. So what do you got there, Mr. Clerk?
Sorry, Mr. Mayor, there was a late change to the agenda here.
I didn't know that.
That is a correspondence from Amy Ferris that's before you.
Thank you.
To deal with request for some municipal significance designation around Friday the 13th.
We know who Miss Ferris is, and we know all about her request as it relates to Friday the 13th, and the clerk is ahead of me. He has put forward a resolution that the agenda be approved as amended with Ms. Ferris's amendment. It's been moved by Columbus, seconded by Guys. Is any discussion on the agenda this evening? If not, those in favor? We're going to proceed with the one amendment. That's carried. Thank you. I just note that Councillor Wells, John Wells, will not be here this evening. He is away on personal business. And Councillor Harold Sonnenberg also will not be in attendance this evening. I've just found out he is away on personal business as well. Thank you very much. So I'm going to ask if there's a disclosure of pecuniary interest. If you have one, would you please give us the nature thereof? Councillor Columbus, please.
Yes, Mr. Mayor. It's with respect to planning application, page 93, application by Miss Diane Smith, DCS 18-31, and also the bylaw 4 OP 2018, page 333, and bylaw 28Z 2018, page 357. These are all part of the same application, and Ms. Smith is a first cousin to me, hence the reason for indirect pecuniary interest.
Appreciate that, Councillor Columbus. Thank you. Anyone else? No closed session today, so the procedure will be simple today to try to get through this agenda. We will plow ahead on this agenda until 10:45, at which time our I like the clock. Till about 10:45, we'll have a break then, at which time we'll reconvene and start our public meetings. There were several this evening. Okay, item 5 is our presentation scheduled for now. We have 2 presentations. What I would like to do is have our first presentation from One Fund Investment Program concerning the endowment model. And then I'm going to ask if there's any questions for this presentation. After that, we'll ask for the presentation from CIBC Private Wealth Management on the principal protected notes, and then I will again ask if there are questions from council members on their delivery. And after we receive, well, we don't receive presentations, we just listen to them and move on. Then we will deal with our staff report 1806, and of course, staff will give the report, and then we will go from there. Would you give us welcome, by the way, and would you, I don't have your name, I apologize, but if I get a name, it's better than hey you.
There you go.
Oh, it's on the board. I know you were here before. Donna.
Hi, I'm Donna Harridge. I'm with
Thank you.
MFOA. I'd like to take the opportunity to thank Norfolk Council for presenting. And with me today, I have Kelly Rogers, which you might remember. She's the president of Rogers Investment Consulting, as well as Brian Holland, who's the vice president of Guardian Capital. So today what we're going to do is do a bit of an overview on the One Investment Program and give you some background information, as well do a quick recap of the endowment model which we presented to you in November. Then we're going to go through next steps. So the One Investment Program is a partnership between AMO, Association of Municipalities Ontario, with their corporation, LAS, which stands for Local Authority Services, plus Municipal Finance Officers Association and CHUMS. We have the highest standard of care. We provide oversight through 2 separate investment committees. The first is the Peer Advisory Committee, which has 8 representatives from the municipal sector. At the back of the agenda, you'll find actually a list of all the participants. We also have the Investment Advisory Committee, which is chaired by a lawyer from Wears Folds that you may be familiar with. It's Heather Douglas, as well as 5 institutional investment experts. We estimate between these 5 people, the committee has about 150 years of investing experience. Finally, when we make investments, it's not MFOA or AMO that is deciding on the investments. We actually delegate that through a set of guidelines established by the various bodies to institutional investors. Our money market, bond, and universal corporate bond is managed by MFS, McLean Button, and our equity fund is managed by Guardian Capital, of which Brian is a representative. And finally, for technical advice, we have Kelly Rogers. When your investments are backed by AMO and MFOA, you should be comfortable and confident that we have your best interests at heart. Remember, we're by municipalities for municipalities. I want to talk a little bit about fees. You may have seen fees. There's been a fair number of television commercials recently. I don't know if anyone has seen them regarding the cost of fees. Well, I want to let you know that the One Investment Program always shows returns net of fees. And as you can see, they're very reasonable, ranging between 0.075% for our HIS account down to 0.06% for our equity fund. The reason for the higher fees is dependent on the complexity of the product. Right now, there's 150 investors totaling about $1.9 billion of investments in the One program. That means that we can use large economies of scale to negotiate the best fees possible. We're very, very cost effective and cost efficient. Finally, what does that mean for Norfolk? When you look at Norfolk, their fees total about $314,000 per year. That is calculated, although we pay fees on a program on the portfolios as a total amount, we've calculated these based on the average daily balances that are in all of the Norfolk account. When you apply that to the balance at the same time at December 31st at $70.1 million, we're talking about fees about 0.45%, which is very, very cost efficient. I'd like to turn it over to Kelly right now to walk you through the endowment model.
Thank you, everyone, and thank you for having us, actually. So if you remember, we went in November, we talked about what your investment objectives are for this legacy fund. And it's our understanding that it's long-term. You want to preserve the principal for future generations, and that's inflation adjusted. You want to maintain your purchasing power. You want to smooth out the fluctuations in the annual withdrawals, where you never know how much you're actually going to have. And you want to be able to withdraw 2.6 million annually and index that for inflation. So that 2.6 million works out to a withdrawal rate of 3.7%. You want to manage the capital so you have sustainable withdrawals. So this is what in the business we know as the endowment model, because endowments and charitable organizations face exactly the same problem. Markets go up and down from one year to the next. We never actually know what our accounting earnings are going to be until the end of the year. But we need to make often need to make multi-year planning decisions. And we need to know that if we plan to spend some money in 4 years, that we're actually going to have that money. So the philanthropic world has developed this endowment model. And what we're suggesting is this is a proven method and appropriate for Norfolk County's legacy fund. So your current approach to the legacy fund is just withdraw whatever we earn, you know? In really good years, we might add to the retention. In bad years, reduce withdrawals. And we have a minimum floor value of 67.7 million. So your withdrawal policy is based on individual discrete 12-month periods. The endowment model says, yeah, but we recognize this is a 25-year time horizon. So it's really looking at more 3 or 5-year rolling periods. And they look at the total return approach. The total return is interest plus dividends plus realized capital gains or losses plus unrealized capital gains and losses. So those portfolios are being marked to market every day. And if you take a sustainable percentage, then you know that some years you're going to be withdrawing money that you didn't earn, and other years you're going to be leaving a whole lot in the portfolio capitalized to grow for the future. So it aligns the investment approach with the withdrawal approach. So we set a withdrawal rate that can be, you can approach it from either direction. Given our asset mix, what withdrawal rate is sustainable? That's one way. Or you can look at it the reverse. What do we need to withdraw, and what kind of asset mix do we need to set to be able to sustain that withdrawal? And you make those withdrawals every single year, regardless of what the markets have done. In the good years, you let it accumulate so that you've built up a cushion that can sort of help you ride through those not so good years. This also allows, if we have a number of good years, it also allows the portfolio to grow beyond simply the level of inflation. So now you've got excess capital, sort of it's beyond your inflation adjusted value, it's greater than that cushion that you want above that, and there's extra money there that if you want to pull it out for a special project or special withdrawals, you can do that. The funds are there. It gives you stable and predictable annual budget contributions. It's a strategy that can manage the volatility. I mean, capital markets are volatile. I'm not going to tell you that they're not. You know, politicians open their mouth one day and the markets go down 600 points. They don't open their mouth the next day and they go up 350. Or it's, you know, you get all of that daily noise. But over the long term, they do go up, and markets go up about two-thirds, or positive about two-thirds of the time.
Kelly, I want to interrupt, and I apologize. I omitted to say our procedural bylaw allows you 15 minutes for a presentation. So I'll certainly let you know when you have 3 minutes left.
Okay.
You've been about 5 now, so you've still got 10
Okay.
minutes. But I apologize for not telling
Okay.
you that. Thank you.
So there is, to make the endowment model work, you need a significant allocation to equities. We'll come back to this. We can come back if anyone has questions on it. But this is a slide that shows if you had started this 10 years ago with the one program on a balanced portfolio, that's where you would be sitting these days. You would have had all your withdrawals, they would have increased, and your capital would have increased despite starting in 2008. We think the one endowment model has significant advantages over PPNs because it better aligns the needs of Norfolk County and the portfolio with the market. And we were going to have Brian speak to this, but since we've got a minute, that's it. Do you want quickly, very quickly?
Sure. I wanted to show you a couple of statistics about the equity markets because we're going to be investing directly in the stock market, high quality investments. I want to show you some data that you might not be exposed to on a regular basis, help guide your decision making. So what I'm showing on this chart here is the importance of dividends. So this is a high quality portfolio and everything pays a dividend in it. It's a sign of quality. Now you might see when you see those dividends, you think, oh, this is a small payment. It probably has little value, but the cumulative effect is huge. I'm showing on this chart here, this is the world index, and you can see the difference between the price return and the total return is significant, and about two-thirds of your return is, slightly less than that, is coming from dividend payments. The next chart I want to show you, and if you bear with me 1 second here so I can orient you on what we're looking at here. This is data going back to 1956 based on the TSX Composite Index, the total return. So if I can direct your attention towards, you see where it says rolling 1 year? If I can just orient you on that slide, that part of the slide, and then I'll explain the rest of it. So what we did is we looked at the returns for a 12-month period, so January to January, February to February, from 56 all the way to present, and then we averaged them. So if you'll see there, we've looked at periods where there are negative returns. So for example, a number of negative periods, you can see 26.84%. So rule of thumb is, if you put your money into the stock market, roughly 25%, or in this case 26% of the time, you're going to have less money 1 year later, okay? And then you look at the average returns going back through time. But go across that line, percentage of negative returns, you see 1 year it says 26.84, you get out to 3 years, it's 10.99, go out to 5 years, 2.19% of the time. You get out to 7 years, it's never happened. When you look at the index data, you look at 25 years, it's never happened. That's what we're talking about. We're talking about a long-term investment approach. Yes, there'll be ups and downs in the market, as Kelly mentioned, but if you're in there for the longer term, you will ride out those waves and have better results.
So that's why one believes that our endowment model approach is superior to PPNs, because in PPNs, number one, the time period is at maturity, which is typically 7 years, and historically we haven't needed a guarantee of capital for periods of 7 years or more. And two, PPNs are based on the price index, not the total return index, so you're giving up those dividends. The endowment model works because of that flow of dividends coming in each and every quarter, which allows it to be sustainable for withdrawals, whether the capital value is up or down. So now I will turn it to Donna.
Okay. I'm just going to bring it to a close. Today we want to make a commitment to you. We'd like to start off by working with David and James to actually get a new asset mix that's more appropriate for the endowment model. Want to work with you to get an investment policy and a portfolio strategy that really works for your legacy fund. We'll work with them and provide assistance in reporting, in looking at oversight of the legacy fund and implementing that new asset mix. And finally, we'll take a look at all the investment options that are available under the new regulations. Right now, I'd like you to give some thought. Your fees in the One Investment support AMO and MFOA and all the good work that we do. Remember, we're by municipalities, for municipalities. At this point, we'd like to take any questions that you may have.
Thank you very much, Donna, and certainly Kelly and Brian. I'm only opening it for questions to Council. Councillor Black, please.
Thank you, Mayor Luke, and thank you for coming, and thank you for confusing me once again with all your jargon and details. I got to tell you, what I've been hearing and what people out in the public are saying to me is they're shocked that, we're making what, I think 275 versus 2 million plus, and we were kind of counting on that 2 million. So is what you're saying through this endowment model, you're saying that, I'm looking at this page of the handout, it says every year you can withdraw 2.6 million indexed annually for capital needs or 3.7% of the value. So exactly what does that mean? Does that mean we're going to make every year $2.6 million for the next?
You're going to withdraw that amount. Can I take a stab at this?
Sure.
So what we do, when we look at the very long term, I can't tell you tomorrow, and I can't tell you next year or next maybe 2 years. I have my ideas, but I can't tell you exactly. But we do know roughly how the capital markets perform in terms of the expected returns, like that chart I was showing on the equities. We know pretty much how fixed income will generate returns, et cetera. So we set the withdrawal rate at a level that is below what that portfolio will earn. So if you know that the expected return on a portfolio is X, right? When you blended them all together, you say, let's withdraw from the portfolio a percentage that's less than that. And we're going to take that money out of the portfolio whether we earn it or not. Because when we don't know if we're going to earn it or not this year or next, but 10 years from now, 15, if you truly have a long-term time horizon, we know that we'll get there and that the portfolio value will be sustained and the returns are predictable. So no, we're not saying you're going to earn that every year. Some years you're going to make more than that, some years you're going to make less.
Okay, and I get it now, and that's the whole idea of the long-term situation. That
And by the way, it's perfect for the community because you have a very predictable level of spending. The model you have right now where whatever you earn, provided you don't dip into the capital, it's feast or famine. This way you have a predictable level of income that you know what you're going to get year in, year out. So it's better for planning purposes.
Thank you. Councillor Doug Brown, and then Councillor Oliver.
Thank you, Mayor Luke. I read and I know we're going to get to it later, but when I read the return, I wondered if it was fake news that we were reading, but I guess it's real. And
It's real?
I guess my question to you is, 2017 was a good year for a private investor. A lot of people made good money that year.
Yeah.
And our return, and I looked at the chart, and we're going to get in another report, and if you look at it, you had I'll use 2 months in there, I believe it is, where you had horrible returns. Like, can you tell me what we were invested in? Do you a lot of bonds or something? What did you buy?
Well, maybe, I managed just one part of it, so.
There's a couple of things that you have to look at. Under the Municipal Act, under a particular regulation, it's highly restricted as to what we can actually invest in.
Right.
So if you want to do corporate bonds beyond 5 years or equities, the One Investment program is the only way you can get that vehicle directly.
Okay, so when in our policy, I think and don't quote me, 40% equities?
No.
20.
20%, sorry?
Yes.
So are you saying with this endowment plan, you're going to invest more in equities that are dividend paying?
Correct. That's exactly. We're looking at changing the mix, because right now your mix is heavily into fixed income, which we've had falling interest rates that have been doing very well. They're starting to turn around. So that's why we're having some short-term capital losses in the bond market. Now I'm going to let the investment experts.
If you ask the question, can we withdraw 3.7% sustainably on our current asset mix?
Right.
My answer is not a chance.
I believe that, yeah.
Yeah, that's just not possible. If you look at the chart that I pulled up, this is rolling 30-year periods from 1926 to 1995. So it includes the Great Depression, and it shows that the blue bar is a 50% equity, 50% bond mix, and withdrawal at a 4% rate was sustainable in 98% of those 30-year periods.
Well,
So you need more equity.
I won't be around in 25 years, I don't think. But my question is, I guess if we're going to have to change our policy then on the equities, is what
Yes.
you're going to ask us for. I guess my question is, what if sounds like an annuity to me, this whole thing. It's similar to an annuity. Give you our money, you're going to guarantee me a payment for so long, right?
We're going to structure it so that it is sustainable. In one sense, though, I can see your analogy. So it's kind of like you're running your own annuity.
Right.
You're cutting out the insurance company and their profit level. Because if you do go to an insurance company and say, I want to buy an annuity that's going to give me this,
Yeah.
they're going to invest the money the way one would invest it.
And I guess I know it. I can see where you're going to make money if you increase the equities into dividends and so forth. So,
Yeah.
I mean, that's not rocket science in my opinion. But I guess, what if it doesn't happen? Where's the money coming from? Sooner or later, you're going to have to pay. And I guess you're going to draw it out of I use the word 70 million. If we have 5 bad years and you keep paying us what was the figure, 2.7 or 2.5 million, at the end of 5 years, we're down, let's say, almost over 10 million. So where's that money, if you have bad years, where's that money going to come from?
It comes out of the capital. So
Okay.
if you look at the screen, the percent of negative periods, 5-year negative periods, from 1956 to from January 1956 to February 2008 was 2.19% on the Toronto Stock Exchange. So if you're in a 5-year bear market, and by the way, the Great Depression wasn't even 5 years.
No.
But you're going to see your bonds are going to be going up in value and offset some of those losses, and your dividends are still going to be coming in.
But you've just said if there's a bad turn and you keep paying us,
Yeah.
that it's coming out of the principal, basically,
Yeah.
right?
And when things turn and it recovers and the markets recover, it goes back into your principal.
When and if.
That example we showed, the example we showed in that with those green bars,
Right.
that started in, testing my eyes a little bit here, 2007 period. It was horrible markets. Horrible markets.
And it was January 1, 2008.
So in many ways, this is a really good example to show you. This is live data.
Right.
It's hypothetical in terms of if had you been invested in it. But it got really bad right away, okay? And then over time, so immediately you lost some value. You think, oh my God, what's happened here?
Right.
But it comes back. But what we're saying to you is, look, as I said before, we're not sure what's going to happen next year or two, but we believe, put it that way, that the behavior of the equity markets will be more or less the same as it's been in the past.
Correct.
So if you really don't buy into that, then this maybe not for you, but
I follow it all the time, but my question is, and I don't want to talk about long-term stuff. I like to look at every day and see where I'm going, but
Sure.
you said your average fee was 313,000 per year? Is that how it worked out?
That's based on the current.
September to September, basically?
That was January to December. It's a one-year comparison of
Okay, I
2017.
thought we operated on a September 1st to August 31st to September 1st. That's our calendar year.
I'm sorry, I just picked that calendar year. I picked the 12-month period and compared it to
We go from September to September, I believe, okay?
Yeah.
But I understood for the year September of 17, at the year end of September 1st, 17, that we paid you $400,000 for that particular year. Does that make sense? Now, you gave me the average since our inception.
It could be depending on what your balances were. You know, it sounds high,
Right?
but if you had withdrawn money,
Right?
you know, so the balances were higher earlier in the year versus at the September date, that would impact, because we don't charge fees on assets that aren't invested.
Do you charge the fee monthly?
I believe so, yes, isn't it?
It's net of returns, they are net of returns which are provided. Your returns are monthly, yes.
No, the fees.
The
When
fees.
do we take the fees?
They are we pay the fees on the portfolio quarterly.
Okay.
Quarterly.
Quarterly. We pay those fees. Yes.
Okay. I think that's it for now. Thank you.
Thank you, Councillor Brunn. Councillor Oliver, next.
Thank you, Mr. Mayor. I just have one question at this point, and it's in relation to Brian's answer to Councillor Black's question. And Brian, you indicated, I think, you would suggest a withdrawal rate, or perhaps it was you, Kelly, a withdrawal rate less than your projected or expected annual growth based on the asset mix.
Right.
How will you determine that expected growth once you sit down with staff and decide how much money to put in what portfolio, et cetera, et cetera? And my question to you, and I guess I could direct it to staff, I assume that council would be informed by staff prior to making a commitment to you folks or to any other investors for us, what the expected growth will be. And we'll see a number, I presume, that would be, quote, our expected growth for the ensuing 1 year or 3 year or 5 year period annually. That's my hope.
Yeah, I can't tell you what your staff will do, but I can tell you that it's not unusual for portfolio managers and for one to look forward and say, okay, the expected rate of return for each asset class, for each type of asset over the next 3 to 5 year rolling period is X. If, for example, a client says, oh, well, I really don't want to have more than 30% equity, but I'd like to take out 5% a year, then I'm going to say that's not sustainable. So then it becomes a negotiation. We came up with the 3.7 because we were told that was the amount that Norfolk wanted to withdraw annually, and that just equated to 3.7% of the portfolio. There was no particular science involved.
The other aspect of this, if I might just quickly add, is risk. And when you look at risk, you're sort of saying, well, let's say you needed the money tomorrow or in 3 or 4 years from now. You might not be able to afford the risk. So that's part of the equation in terms of how the asset mix is developed. But when you look at this endowment, this legacy fund that you have, theoretically, Kelly put on the slide 25 plus years, but theoretically it's 100 years, 200 years. It could be forever if it's managed properly. So you have, when you look at that, you have a very long-term horizon in terms of your risk tolerance. So you can afford to take some level of risk. And so we came up with that hypothetical example. It might be something different when we meet with staff, but that was part of the guiding principles, is that you have a very long time horizon. You have some short-term spending needs, and we've set that in this theoretical example, low, so that we can meet it. We know we can meet it, but if you have more ambition or whatever, you're willing to take more risk or less risk, we can dial it up or dial it down. But let's not forget, and I think you need to get away from the one-year time horizon analysis. This really is, think about 25 years, think about 50 years. And when you look at some of the negative periods we've had in the markets, they'll be barely noticeable when you look back a couple of decades from now.
Thank you, Councillor Columbus.
Thank you, Mr. Mayor. How many other municipalities are you involved with? And how are they faring compared to Norfolk?
The returns for all the portfolios are the same. What would be different is the asset mix. So we have about 140 municipalities invested with the one program, as well as about 10 other, I'm going to call them paramunicipal. They could be conservation authorities. They could be social services boards from up north that are groupings of municipalities. So it all depends on their asset mix, and they would vary depending on what, how much they have in equities, how much they have in the different bond market, how much they have in HISA. So each one of the products would have different returns.
And with the central bank raising interest rates, that's going to be probably coming forward on a monthly basis, do you figure that will change our numbers much?
In terms of which numbers?
Our returns.
Oh, yeah. It's going to, they've raised rates 3 times since last June. I'm hearing from some that, yes, we can expect continued increases. I'm hearing from other economists that, are you kidding? The Canadian economy is slowing down. One was quoted in today's Globe and Mail of saying we're going to have negative interest rates in Canada. Certainly, we're expecting to see interest rate increases, certainly in the U.S., and I think we've prepared the fixed income portfolios have been prepared for that. The bond fund is a maximum term of 5 years, and it has been, on average, had a shorter term than its benchmark, than the index, to give it some protection in a rate increase. And on the Universe Corporate Bond Fund, we were concerned about this a year ago, so we undertook an analysis of and implemented in November a shortening of the term in the Universe Corporate. So yes, it will be impacted, but we're relatively, in the bond fund, it's a short-term bond fund, so it will have less of an impact than a bond fund that included 30-year bonds. And on the UCB, its term has been shortened as well.
Okay. My last question, this asset mix that you'll be talking to our staff about, could it include real estate and infrastructure investment? I'm thinking
Not direct. Under the current regulations, and when they are revised, one can only invest in shares of Canadian corporations. So, for example, Brookfield Infrastructure, it's a limited partnership. Even though it trades on the Toronto Stock Exchange, we wouldn't be able to buy it, and we are not able to buy REITs.
So it has to be Canadian.
Shares of Canadian corporations.
Okay. Thank you. Thank you.
Now, if you decided at some point in the future to move to the prudent investor framework, then you could do anything you wanted.
Thank you.
Councillor Brunton, please.
Yeah, thanks for Mayor Luke letting me speak again. I had asked the treasurer there last week, I sent a memo to all the council. I wanted to see a copy of where we're putting the money. Portfolio, where is it? Like in different bonds, different stocks, where are they?
Okay, so we usually don't give a complete listing of what all of our holdings are, but what I did take a quick look. So our bond fund, it totals about $270 million. This is as of the end of February and has about 40 holdings. About 2/3 of it, or 63%, is in basically different types of governments. So in provincial and large municipalities, we have about 32%. We have Canadian governments about 15, and then quasi-government, it's the Canadian Housing Corp, is about 16. We have about 30% in the bond fund in major banks, and this is basically all of them: Nova Scotia, TD, CIBC, Montreal, Royal, HSBC, National Bank. We have about 3% liquid in cash, and then the 4% is split between other areas. So that's our bond fund.
Can we have copies of that?
I can give you, if it's okay, I'll work through James and then get you some more information perhaps. I've got to work with my people back at the office. They're concerned about how much detail we provide to you.
Yeah, well, like that'll show us the bond rates and everything that
We probably won't go to that level of detail. We pay management fees to get that particular area, that detailed information. I do have some information on the Universe Corporate Bond if you'd like.
Oh, I like to see it all. I like to see where our money is, where you've invested it, particularly in 2017, where we had a substantial loss, in my opinion. So I want to see where, and I suspect you were into a fair amount of bonds at that time.
Well, we know that 80%, yeah.
Your investment policy says we have to be 80% in bonds.
That's why I want to see which ones they are.
They're all very high quality because of the restrictions on the ratings.
Well, they couldn't have been too high a quality because they didn't pay much. Thank you.
Councillor Black and then Height, please.
Just wondered, well, you know, I'm not interested in that much detail because I just wouldn't understand it, and I would prefer to work through James in regards to that type of detailed information. But can you, is the information available on what the total fund is? Like of all the 140 municipalities or quasi-municipalities? Can you tell us what that amount is?
It's as of this morning, it was just under, it was $1.79 billion.
1.79 billion.
Billion, yes. And we can actually provide a split by each of the portfolios if you'd like.
All right. So I know in the beginning when we first started, it wasn't anywhere near that. So it was rather small in comparison. So it's been building up.
One of the things we're finding is the municipalities, there's a big emphasis on asset management planning, which is a very long-term proposal. And we're finding that municipalities are getting a much better handle on their cash flow and that they're realizing that the benefits of investing and long-term, namely some of the equity and UCB fund, or Universal Corporate Bond, which are more longer-term investment vehicles. You're welcome.
Councillor Height.
Thank you, Mayor Luke. Through your deputation. So with the endowment portfolio, equities obviously have to be increased from our minimum standards. So in the bottom, the footnotes there, you were recommending, what, 60% equities?
In the hypothetical, yes.
In the example, we used a 60% equity, which is quite typical for an endowment. We can't recommend a specific level yet without working with staff and better understanding your objectives.
Okay, so now I did want to correct you earlier. You mentioned that our bylaw basically could only allow 80% in bonds. It's actually 60%. I have the report here in front of me. It's 30% bonds at a minimum, and corporate bonds is 30% as well, just for clarification.
Okay. Thank you.
In your endowment portfolio, have you done this before? I'm familiar with the PPN and we're familiar with the rates of return, but with this portfolio, do you have a benchmark?
Well, this is an approach, okay? So this is an approach, when you say, have we done this before? This is the way the rest of the world does it. This is the way pension plans do it. This is the way endowment, this is the way most organizations do it. And Kelly and I have lots of experience in managing portfolios in this regard. With regard to the mix, you could leave your mix as it is, but you'd have to lower your spending because otherwise you would start eroding the capital base of the portfolio over time. So just because we've put forward an example doesn't mean you're in that. It could be anything. It could be current, and then you would have to lower your sights with regard to spending.
Right. I guess through the mayor to you, that I'm struggling a bit with this 2.9 million that we keep taking it out, but we're not really getting returns. That we've only got 1 out of 3 years so far that we've actually hit the 2.9. So we would continue to erode if we don't perform.
Exactly. The mix that you have of 80 or only 20% in equity and 80% in a combination of fixed income cannot sustain that level of withdrawal.
No, not in these interest rates, I agree.
No, absolutely cannot. So
Right.
you're quite correct there.
But with equity, like more shares in equity comes more risk. So-
Well, it comes more volatility. So yes, it's short-term risk, but it's volatility. It's not the risk of a bankruptcy kind of thing. If you remember in 2007, 2008, the sky is falling, financial crisis, sell everything because everybody's going bankrupt. Well, the Royal Bank didn't go bankrupt. Magna didn't go bankrupt. Canadian Tire didn't go bankrupt. They all came back. Maybe not so much Bombardier, but I'm hoping we don't own any of that. No. Yeah.
Right, yeah, I'm familiar with that
And
very well.
the other thing that makes the endowment model sustainable is when we look at a typical portfolio that has, say, 65% equity, the amount of cash yield, depending on the manager's approach, will range from about 2.5% to just over 3%. That's the combination of the dividends and the interest income. So if you've got a cash yield of 2.7 and you have a withdrawal rate of 3.7, you're counting on 1% capital appreciation. But the average long-term return for equities, even in a lower return environment, is in, 6 to 8, 7 to 10, or 7 to 9. I'm not suggesting we're going back to the rah-rah days of the 80s and 90s where we were getting, returns of 12, 15%. We don't need those kinds of great returns to make the endowment model work. We need an average return on the portfolio over the long term of, 6, 7%. And when you look at periods of over 10 years, most endowments, and you can actually find this information publicly because lots of charities and foundations put it on their websites, and they compare themselves to each other. They've done much better than that 6 to 7%. And many of them have had higher withdrawal rates. They've had to be more aggressive because they want to give money away. So they said, well, we'll accept more volatility so that we can give away more money.
Okay, and my next question, if we get more heavily weighted into equities, I'm assuming this is the fees, they also increase up to 0.6, is that the slide I'm looking at?
Only on the equity portion, that the fees charged on each asset class do not change. Your fees will go up though because you'll be taking money, for example, out of HISA and putting it into equity. So yes, there'll be a change in fees, but it just gets calculated out.
Let's also not forget that the fees that in the one portfolio program, these are wholesale rates. You couldn't get these, on a retail basis in mutual funds. The way this works is that we were hired on a competitive search, okay? And then Kelly holds our feet to the fire to make sure we're doing a good job, as does the investment committee and the oversight committee. And you're getting that at a rate that you couldn't get anywhere else in terms of an actively managed portfolio.
With all the regulatory restrictions that you have.
So, and I meant to ask you about that. You mentioned that municipalities can't hold a bond that has a term of over 5 years?
Corporate bond.
A corporate bond, but municipal or provincial bonds you can, right?
Yeah.
Okay, so like Horizons, HMP, they have a yield of 2.05%. We could hold that.
I'm
And
sorry, Which one?
Horizons, HMP, or there's iShares, Government Bond Index. They both have actually had a yield this year of over 2%, and their fees are less than your fees.
I'm not sure you could hold a government bond index because an ETF is not a bond. The regulations, you could hold a Government of Canada bond.
And a provincial and
And
municipal
a
bond.
provincial, a municipal, or government agencies. Well, that's not Horizon Bond
No,
Fund.
I'm just saying,
Okay.
it's fairly straightforward to find 15 bonds through the province or the feds or municipalities to make up your own index, and the municipality can hold them.
Oh, yes, absolutely. The municipality can manage their own bond portfolio.
Right.
Yeah.
Thank you for that.
Thank you. Mr. Columbus?
Thank you, Mr. Mayor. You mentioned prudent investor. Can you describe that process for our council, that program?
Prudent Investor is, the legislation came out on March 1st of this year. It is not effective till January 1st of next year. It is basically a way of looking at Prudent Investor, really opens up and allows you to diversify your investments. But it comes with two major things, and there's a lot of details around it. The first is there's a financial criteria about whether or not you can have you can go into Prudent Investor on your own, and Norfolk right now does not meet that criteria. So you would be looking at what they called a pooled. So you'd be looking at a pooled approach to this investment model. There is two big downfalls with this model, is that there's a significant governance structure. For example, there's an investment board that you have to either create. In your case, you would have to sign on with an agency of pooling of municipalities to join this board. There's a specific restriction that they are allowed no staff. There are no councillors allowed on this board except for the treasurer. If you're looking at a pooled grouping, you could only have a 25% makeup of treasurers. As well, there's a significant reporting structure associated with Prudent Investor. So although you're allowed a greater amount of flexibility and diversification of your investments, there's a much greater diversification or complex reporting and governance structure associated with it. You're welcome.
A couple of questions, and then we'll move on. From myself, just looking forward here, Donna, if we were to go to the current program into the endowment, your fees, I believe, would be in the neighborhood of $315,000 per year, or the 0.45%?
If we were to go to the endowment model, your fees will increase simply because your proportion of investments in the equity portfolio that has a higher fee structure would increase as well.
What of our investment fee percentage? What is our administrative fees or management fees been over the last 3 years per year?
I don't know. They would probably be in the ballpark of about high 200,000 to 300,000, depending on the value of the portfolio.
Okay, for some reason I thought they were over 400,000. The other question I have for you is, I take it from your presentation, the endowment, we could expect to withdraw 3.7% of our investment annually.
Correct.
Which would be about 2.6 million.
Correct.
How would we be locked in for the 10-year period? Would we be able to break that? Would there be a penalty? I can't speak for future councils. Tell me about that a little bit.
You are never locked in. Remember when I was talking a little bit about the makeup, there is always cash in each one of these investments. The reason we talk about locked in, or the amount of time you invest, is it goes back to that slide that Brian talked about, where what you don't want to do is pull out your money at a time, or have to pull out your money at a time where you're going to incur a loss. For example, when we started the One Equity Fund, we had an investor that started off in 2007 with about $500,000. In 2009, that same amount of money is worth $340,000. They lost 40% of their value. If they had actually sold those stocks at that point, they would have made an unrealized loss and realized